Welcome to STRAT this week. Will Woodall, Mike Rarey. It's the last week of March.
Yes.
And a lot went on last week, so we're going to talk about a lot of what happened. But all in all, for the week it was, and the Fed speak that came out, it was a pretty decent week for both bonds and stocks.
Yeah.
I mean, all asset classes almost. So let's take a quick look at equity returns.
Yeah, it was not a bad week. I mean, if you like drama, it was a bit of a letdown, right? The Fed meeting was very hyped. I mean, we hyped it up. It was worthy of hype, but ultimately sort of let us down. Equities positive on the week. A lot of volatility from point to point, but basically the S&P 500 up 1.4% for the week. Small caps rallying a little bit, and then seeing foreign equities also up. So
yeah, it's interesting. As much as it was overhyped, reading the post-meeting sort of transcripts or play-by-play after, I don't think people interpreted his messages very differently, which we'll see in sort of the upcoming charts here. But let's look at fixed income for the week.
And fixed income, even though the Fed hiked 1/4 percentage point and said they're going to continue quantitative tightening, positive returns across the bond space. So especially shorter term yields, things like the 2-year yield. I mean, we're going up or down 20 basis points a day now on the 2-year. So the bond market is really struggling to reprice the trajectory of short-term interest rates. But last year they were down last week they were down point to point for the week. So positive returns in short end of the Treasury curve, and then also seeing bond spreads come back in just a little bit. Still, if you look at, for example, high yield bonds month to date in March, still with a negative return. Bond spreads are definitely wider than they were at the end of February.
Right.
Yeah.
And then in the alt space?
Alt, not a whole lot going on. All the volatility wasn't last week. It was the prior week and the week before that. So yeah, nothing too exciting.
Not too much, yeah. So let's move on to sort of the expectations post-meeting. So Powell spoke. I heard a lot of, we're not cutting rates. I mean, specifically, that he said we are not cutting rates. So that message, I don't think was interpreted well by the market, as evidenced by, I think, our Fed dots versus market expectations.
Right. So yeah, they came out, they hiked 1/4 percentage point. They said they're going to continue with quantitative tightening. So they were able to say, hey, we still have our foot on sort of the brake of the economy, trying to slow the economy down through tightening financial conditions in order to reduce inflation. Inflation is our #1 priority. We need to defeat inflation. And since this was a quarterly meeting, we got the added bonus of getting the dot plot and the summary of economic projections. And so this is the dot plot. You all, regular viewers have seen us talk about the dot plot previously. Each of these gray dots show an expectation from one of the FOMC members about where the Fed funds rate should be at the end of this year, next year, and end of 2025. So you look at all these dots around the end of 2023, and you sort of gather a central tendency that the Fed is expecting to do one more hike and then not cut. No cuts. And we've contrasted this with the blue line, which is what the market is thinking is necessary. So the market is pricing in from here 75 basis points worth of cuts by the end of the year, and not sure yet if we're going to get one more 1/4 percentage point hike in May, most likely not, but then cutting as we get into the second half of 2023. And then as you go out, the disparity between what the market thinks and the Fed's dots, it closes somewhat. They get a little closer together, but not too far. So, did the market take the Fed seriously in terms of guidance on, hey, we're not cutting rates, we might even hike another time? Absolutely not. The market did not take them seriously at all, and they probably shouldn't, because historically these dot plots don't have very good predictive value. I mean,
Especially the further out you go.
Exactly, yeah. The 2023 dots, those could be off plus or minus 1%. The 2024 historically would be off plus or minus 2%. So, I mean, it could literally be anything.
Yeah, right.
Yeah.
But given what he said and what has already transpired in terms of what's broken, and they're not talking about cutting. I mean, specifically, he's saying we are not even considering that.
Yeah, the decision was unanimous to hike.
It was. So given that, having an expectations of 75 basis points of cut seems ludicrous. Like, it seems like people who are in the market are suggesting this have never been through a normal rate hike cycle before, because this would, if we had, what else would need to break to have a reversal like this?
Yeah. You would think between now and the end of 2023, what would need to happen is evidence that the Fed won the war against inflation. So we would need to see inflation come down very quickly, and that would have to be accompanied by softness in the labor market. And once again, what does softness in the labor market means? Some type of increase in the unemployment rate. And historically, that, a 0.5% increase in the unemployment rate in a 12-month period coincides with a recession every time. So basically, by the end of the year, for the Fed to be wrong, you would need to see inflation come down and a recession transpire, basically.
Right. And we are not forecasting inflation coming down.
Right.
And I think the Fed they're forecasting inflation is coming down a little faster than our estimates, perhaps. But if we don't get that deceleration in inflation, this is what happens. Like, how does this get repriced higher, and what happens in the market?
Yeah, the first thing that would happen is short-term interest rates would move up. The 2-year is down significantly since March 9th, which is when the whole banking crisis started. Those would have to come up. Longer-term bond yields would have to come up. But then more importantly, equities would probably come down to offset that, particularly growth equities. So, we will see. Never a dull moment.
I think, again, as we said, I think we said a couple weeks ago that March would be the pivotal month.
Yeah.
And I think we'll look back at the end of the year and March will be the pivotal month.
For sure.
All right, let's look at an update to the balance sheet of the Fed here.
Yeah, what the Fed doesn't want you to be looking at, right? I'm going to keep hiking because everything's fine. Sort of don't look behind the curtain where, as I press on the brakes of the economy, things are flying out the windshield. And I'm sort of flying through the windshield, and I'm sort of scrambling to save everything. And that's what's going on with the loan side of the Fed's balance sheet. So that green line is total loans. That's the Wednesday level. So these are through last Wednesday. And the green line went up again. We talked about the big spike last week. Well, it went up again. And I know the news has been covering how discount window lending has decreased week over week. Great signs that the banking stress is behind us. But what's more than offset that has been increase in loans to the bridge banks established by the FDIC, which even though Signature was sold and Silicon Valley Bank were sold, the FDIC still has assets and they still may need loans. And then another thing was the Bank Term Funding Program is just now starting to get used. We're looking at 40 billion worth of usage last week, so that's not insignificant.
And explain that in terms of how that works.
Yeah, so if you're a bank and you have treasuries or mortgage-backed securities, you can go to the Fed and they can give you a loan for up to a year based on the par value of those bonds. And the idea is, instead of you having to sell these treasuries and mortgage-backed securities and take a big loss, which will eat into your capital, you can just pledge them as collateral. The Fed will give you cheap funding at par value of those bonds. So, you avoid the fire sale. So that's clearly happening. Right? And those loans are assets. So you see that purple line just keeps going up. This is not tightening.
They're temporarily, right? These are
all temporary measures. This is, if the Fed came out at the meeting last week and said, hey, we're done with quantitative tightening, we're going to resume securities purchases, that would be a pivot.
Right.
If they said, no, we're not going to hike, we're going to cut, that would be a true pivot in terms of liquidity. This is just patching up wounds temporarily. It's not really curing the underlying issue.
And what's the potential for this to get worse or to be taken up more?
Oh, definitely. Our estimate is that over the next 10 weeks or so, and this will change as every week when we get more data, over the next 10 weeks or so, about 40 billion worth of bank term funding program usage per week. And well, why is that? Well, why wouldn't you use that if you were a bank, right? It's going to be way easier than selling all your treasuries and mortgage-backed securities and realizing a loss, a mark-to-market loss. So 40 billion a week for 10 weeks, that, it tops it out at somewhere around 450 billion in total bank term funding program usage. And that to us seems like sort of base case scenario. If you take the top 5 or 6 banks with the highest uninsured to total deposits ratio, and you look at, the value of those uninsured deposits, it's in that neighborhood. So that's sort of base case. It could be as high as 2 trillion. Unlikely, but it potentially could be as high as 2 trillion.
If you were a bank and you're like, hey, I could arbitrage the spread here, make some money.
Yeah. There are opportunities like that. So.
Okay, fun stuff. So let's look at what this does to our net liquidity forecast, which has rapidly come back in line here.
If we were day traders, if we were trying to time the market, perhaps, we would look at, hey, there's going to be demand for loans. It's going to increase net liquidity on a temporary basis. Growth assets may have, like growth equities may have a temporary floor underneath them. But we're not day traders. We're looking at liquidity 12 months out, and the type of liquidity matters. This is short-term, plug the hole type liquidity. This is not a pivot from the Fed. And so you see this green line go up. It suggests that right now the S&P 500 is at approximately liquidity implied fair value for now. Right. We will talk later about what does our liquidity projection for the next 12 months look like. Like, it's not that exciting.
Right. And once this program ends, that line will shoot right back down.
Exactly. These are all temporary measures.
So let's talk about our liquidity forecast.
Somewhat exciting. So you see that light blue dashed line, a nice spike in liquidity. So we were, prior to the new bank term funding program and all these emergency measures that the Fed has enacted to save the banking system, our forecast was hovering right around the 0 line for the next 12 months. Right. And what you see here now is a spike almost immediately, to take into account the fact that Fed assets have increased about 450 billion in 2 weeks. But then from there, the fundamentals of the situation haven't changed. I mean, if you're not going to hike the Fed funds rate, cut the Fed funds rate to 0, and you're not going to flip from quantitative tightening to quantitative easing, and we're not going to get fiscal stimulus because nobody wants to put their name next to anything that could stoke inflation, well, then you just go sideways from there. Yeah. Very unimpressive, I guess is what you'd say when you look at that. So once again, we're calling regimes. This is still low. This is still low liquidity and not very high conviction in rising liquidity.
So you mentioned fiscal stimulus. What are the chances? We're starting to see more articles about fiscal stimulus is coming. What are the chances we get another round of fiscal stimulus?
Well, in a divided Congress, very low, very, very low. If in terms of liquidity, personal income transfer payments show up in our liquidity model, and those get paid out when unemployment benefits get paid out. So that type of stimulus, sort of automatic, if we get any weakening in the labor market, that might happen. But, to think, given that inflation is still public enemy number 1, to see any type of meaningful, proactive acts of Congress to initiate stimulus, I would not bet on it. Yeah.
Okay, so let's look at inflation, update to our inflation forecast.
Yeah, not a whole lot, just going sideways. I mean, core inflation, just once again, just slapping the Fed in the face. And that's why they had to hike a quarter of a percentage point.
He said in unequivocal terms several times, we will get the inflation rate to 2%. Not to 3%, not to 2.5%, to 2%.
And this was probably their opportunity to change the goalposts at this meeting. Acknowledging that things are going on in the banking system, saying, hey, if we get it to 3%, that's not a bad deal. That's not a bad deal. The market probably wouldn't have taken that that badly.
Yeah.
It was their opportunity to do it. You have an excuse. You have banks failing. And they didn't. They reinforced, we're going to get core PCE down in the comfortable 2% range, and that's going to require some more hard work.
And on the economic growth side?
On the economic growth side, that green area, that's the economic surprise. It's positive. It's above zero. That means the economic data keeps coming in better than expected. That's really been the story all year. And once again, this is another reason why the Fed needs, they need to say they're still hiking, even though from a reserves and assets perspective, they're not really tightening anymore. But they need to say they're hiking because economic growth is not slowing down fast enough to give them confidence that inflation is going to come down fast enough. So then we throw that blue line on there, which is the financial conditions index. And when the Fed thinks about how can we bring down inflation, what they do is say we're going to hike short-term interest rates to tighten financial conditions. That would mean this blue line would come down. And then that would lead to a slowing in the economy, which would lead to softening of the labor market, which would lead to slowing inflation.
Right.
And thankfully, the blue line came down, but not because they hiked rates, because high-yield bond spreads widened out quite a bit since March 9th, because the dollar has strengthened here recently. So for those reasons, basically, banking crisis type reasons.
Okay, and then finally, I think the recession forecast.
So not a big change week over week. If you look under the hood, and you look all the way out to the right, all of the underlying indicators that go into our recession forecast, still, if you're just counting the number that are red or yellow, you would almost think the recession probability was higher. And we've reiterated this sort of over and over and over again. It's SOM and PIGER, the bottom section, the short-term indicators, have not budged because they have labor market indicators in them. And so what that basically means is our recession indicator is sort of hanging on by a thread here.
Yeah.
If there's any softening of the labor market, then recession probability in our model would pick up quite a bit. And you think that's basically what the market is realizing now as well, and has known, all year, that if the Fed is successful, recession is likely.
And so I had a question this weekend from someone who said, the labor market is strong, but why are we hearing about so many layoffs?
Yeah.
It just keeps continuing. Like, how does that trend in layoffs and layoff announcements filter through to, because there's a mismatch, right, in unemployment.
Yeah.
It's not always the same jobs that are available that you get laid off from.
Yeah, so that's part of it. The other part of it is those layoffs that you're hearing about are usually from large companies, right? And we know small businesses employ the lion's share of overall employment in the country. And then the other thing that we know is the services sector is doing extremely well and is very labor intensive. So, the bar and the restaurants and the retailers down the street, you're not going to hear about layoffs on CNN from them, right? Or any other news outlet. You're not, and they're still help wanted.
Yeah.
I mean, pretty much any restaurant you go to is help wanted.
Yeah.
And that's why. And then the other thing that's happening is at those larger companies, although there are layoffs maybe in one part of the business, there could be hiring in another part of the business. I mean, you look at like Microsoft, for example, that's happening. Layoffs in one side of the business and then refocusing on another side of the business. Those are netting out.
Yeah, I went to Home Depot this weekend to get some home project supplies. And then when you walk in, they have by their service counter, they have a listing of all the job openings. And it was all the way to the bottom of the, they didn't have any room to write another job. It was just probably 13 or 14 different jobs for that store that were open.
And there are so many employers and companies that are sort of fighting the last war. And what was the last war? Well, the last war was you had this big post-pandemic boom in demand for their products, and they were scrambling to rehire, and it sucked.
Yeah.
They couldn't find people. When they did, they had to pay them more than they otherwise would have had to. And so they're thinking, yes, we see the slowdown in demand. We see everything on the horizon in terms of the economy. We get that. But if demand comes back, I do not want to be in a position where I just let people go and now I need to try to rehire them. I'm fighting the last war, right? So the labor hoarding behavior You know, when we've consulted clients on the strength of the labor market in their industry and the labor cycle, there's a cycle to these things. All the things leading up to actual layoffs have happened. But the layoffs, it's like, just not happening.
Just not happening.
You know? So.
Yeah. Yeah, the other part of that story was the parking, it was probably 1 o'clock on a Saturday afternoon. The parking lot was virtually empty.
Probably except for me.
Anyway, all right, so that's a good update for the week. Got some employment data coming out next week?
Yeah. Next week we'll have the employment data, and then
March roundup.
Yeah, any other updates going on in the banking system.
Awesome.
Right.
Well, have a great week. If you have any questions, let us know. Till then, have a great week.
Thank you.